Right, hello. So today is the 31st of March. Actually, today is the last day of the quarter. So very interestingly, what we can look at, we can actually have a look at what the 3 months chart looks like. So let's have a look at SPX. SPX, right? So yeah, it's looking rather big dump compared to 2000 and 2008 financial crisis. Look at this, we had 56 drop, and here from the top we had 35% drop. So I mean, it's huge dollar wise. Let's see, dollar wise we had drop of 1226, and here we had 900. So magnitude wise it's bigger, right? But percentage wise, because we're so high up, it is smaller. So but it's so violent, this drop is so violent. The only thing you can let's have a look at DJI, right? DJI, I did a chart of DJI, but like if you look at it like this, right, it goes all the way to 1915, when the DJI is one of the second oldest ETF or index tracking thing. And if you have a look at 1929, that's over here, right? We had a massive drop of 87, pretty much 90%, right? We had, and it looks so tiny compared to us. But what we do is, if we go to log scale, then which is percentage, it's based on percentage, and yeah, it looks like that. So if you have a look at this chart here, what I've done is I've drawn a trend line on the log scale, top and bottom, and then I did a midway point as well, and you can see it's pretty interesting. It's very interesting to me, I guess. You could we're exactly rejected pretty much from this logarithmic trend line here, and then we dumped, this is on 3 months, and 3 months is about to close. You can see here it closes in 12 hours, right? So very interesting, and we still haven't touched the middle trend line. I mean, it's not perfect here, because in this area here you can see that it went over the trend line beforehand, and then over here once again it was a resistance, and then it broke through. Here it was a bit of a support. We're going to come back and touch it here, or or we don't. We can just keep going up, because now the Federal Reserve has the policy of helicopter money and just printing the money. The Americans recently passed 2 trillion bill, and they're giving money pretty much to everyone. They're giving money to the corporations, like a company like Boeing, for example, and a bunch of other companies that even did share buybacks recently. And now they're asking for bailout, or they're gonna stop exiting, and government has no choice, pretty much, because due to the current policy and the way that they think about economics, excuse me, and the way they think about economics is basically they're gonna print money, and they're gonna throw money at everyone just to keep the economy going, and that's what they've done. And they're even giving money just to normal citizens, like all over the world. America is giving like $1,200 US to people that lost their jobs. Australia is doing it, Hong Kong, everyone's doing it. So they're basically printing shitloads of fiat, and they are giving it out, because their current understanding of the economics is that you need liquidity. This is a liquidity crunch, because nobody will have liquidity once this coronavirus is play it out, and all the businesses will shut down, and then everyone will suffer. So they're saying it, hey, if we provide enough liquidity so that people don't get fired from their jobs, as soon as this lockdown on the virus is over, they can start, they can start up again, and they can, um, they can restart the businesses, and then we can, hanky dories. Anyway, that's their plan. They want to print their way out of it, but by that they're creating lots of debt. Anyway, if you want to know about stuff like that, you should probably research, how money works and how the current system works. It's pretty nasty the way they've done it. So yeah, look at this perfect touch there for SPY. But looking at the 3-monthly chart, which is pretty much closed, it closes after today, right? So one more day of it, and right now the key thing is that it has lost an uptrend. It's no longer in an uptrend. You can see that it was in an uptrend since 2009, basically. High low, high high, high low, high high, high low, high high, high low, high high, and now we got a lower low. So we're in a lower low territory, which is we are playing out the bearish divergence, and we can expect, we can expect anything, I guess. But what we see now is it's a decent size. It's 50-50, right? It's about 50-50 on the body compared to the. So you got, but then again, over here this is 29%, and here is 31%, 62. So the wick size is pretty decent. Excuse me. It's pretty decent, and the other thing is that we are getting supported by this weekly 21 EMA, which we have not broken before. And it seems like unless we dump today, which is the last day, more than 4%, then we will close above it. It gives a confidence boost to the bulls. You can see here as when we broke it in 2008, that's when we had the most fierce dump here with the largest volume, and then we bottomed out 50% below it, right? So it's huge. It's huge dump after we broke below it, so we don't want that. There was a scare over here, but bulls bought the dip, and then we haven't really touched it, and we were more guided by this 8 EMA, which is the green one, and you can see we were closing above it, and here we had a signal saying that, hey, bulls, be careful. Bears actually do have some ferocity, but then the Fed basically lowered interest rates for the first time in a while, and then the market basically priced in the zero interest rates because they understood that most likely scenario is that the Fed is going to zero. So now we are at zero, and now the market needs to price in this unlimited QE and unlimited printing of money. Let's see where it goes. We can go sideways for a while. We can even go back up. We can go down. What we need to do, if we are a technical analyst, we just need to play it, day by day, and as we get more information, we can say. So key right now would be to not to break this. If we break to lower low, that's it. Like It's unless it's some sort of a fake out, it's over. We're downtrending, and then like we're in trouble. We're in big trouble. We're playing out this bearish divergence. So if we look on the monthly, monthly looks like a long wick as well, huge volume here, and the bulls bought the dip, and now we got huge range. So most likely scenario, doesn't mean we're gonna go into the most likely scenario. The most likely scenario we're gonna be inside this range for quite a while, right? And this range is 35% this way, 50% that way. So we can bounce 50%. Excuse me. Yeah, we still won't get to the high. Well, not 50% from here. So from this point onwards, we need to bounce 30% to get to all-time high. So very interesting times. This is historical times. Obviously, this has never happened before, and amazing. And I don't know if you've seen this before, but I posted this even before this whole thing happened. You could even draw it like as a massive wedge here. Check this out. It's easy to do it after the fact it happened, right? It's a massive wedge, rising wedge sort of thing, but we're in the log scale. That's why it's so weird. I was wondering why it looks so weird. So in the log scale, it looks like a wedge, which is really cool. In the normal scale, you got this trend line here, which I had drawn before it happened. And I was saying that the bulls need to be careful. Bulls need to be careful. Bulls need to watch out. And we basically, what happened here, we tested it the first time, rejected, we rejected the second time, and then we had a massive down. So, it's rather crazy. Actually, I had it drawn like this, right? I had it drawn like that, which was, yeah. So, and I tweeted it beforehand when we were just reaching it on the first candle here, and I said, look, bulls, be careful here. And then we got rejected, so I thought, all right, that was the first coronavirus scare. And then we realized on the second time it went up, I was thinking, oh wow, it didn't, it got rejected. This reversal monthly candle got rejected, and we were bullish once again. This candle here, it looked bullish in the beginning because it was right up the top here. But then the more coronavirus knowledge was, discovered, and we basically found out that it's really bad and the country is going to be closing down. So boom, we had massive dump, one of the most fiercest dumps ever. So anyway, what do we got now? We got this weekly range, and we had a nice bounce. So one of the guys on the Twitter basically posted, this is the only time we've had a bullish engulfing candle at the bottom of the trend, and the only other time it happened was in 2009 at the bottom of the great financial crisis over here, and that basically marked the bottom. It marked the bottom, and then from then onwards, all we had was we were going up and up and up and up. Obviously, he said that it is not a call for the bottom, but nevertheless, it's very interesting. And if you can see here, what happened afterwards is we had this bullish engulfing candle here, and then we basically did not consolidate. We did not consolidate more than 0.382 for years. Right, the first time we consolidated to 0.382 was at this point here, and that was in 2010. So in 2010, middle of 2010, and this was in March of 09. So basically for one year, 483. So more than a year, 1 year and a few months. So that was back then, and that's just an interesting point, right? We did not consolidate a lot at all. So we are, and that's why if we look at the price action right now, that's why right now we're also getting a follow through, right? We're getting a follow through on this bullish engulfing candle. We're getting a follow through, and we still haven't broken the top here. I think we just tested it. Double, we almost double topped. I think with the extra hours, even with the so we did break it on the extended hours, but so very interesting today when the market will open. So today is the Tuesday, so we're gonna open the markets and see what's going to happen, whether we bulls can have a follow through, or this will be a perfect double top hunt play, and we will dump. Right now the market, pre-market is already open just about an hour ago, and so far the bulls are trying to push through. And that's the psychology of this, which I did misplay. I did misplay this, but the psychology here is that basically everybody on the news and on the all the Twitter, everybody is basically saying, look, this is the worst dump we've seen since the Great Depression. And what happened in Great Depression is basically we lost 90%, right? We dumped 90%, but you can't really compare the Great Depression to now, right? Because back in Great Depression, there were in the dump back then in 1929, that market was completely different to what it is now, because basically you had all the bankers and you had all the professional traders trading, and then they basically allowed the normal public to buy in, and then they basically ran the market up to the climax top, and then they dumped on everyone, right? That's what happens every time, right? You get too overbought, then you dump. You dumped huge here, and then, but look at the weekly here as well, right? We reached the bottom, and then we bounced for 1, 2, 3, 4, 5 weeks, right? We reached the top in the 5th week, and then we started to consolidate. We consolidated to 42 days, right? 42 days to find the bottom, and then we found a weekly high low. And the interesting thing, that weekly high low was just below 0.5, just above 0.618 golden pocket, right? So it didn't even consolidate to 0.618. Excuse me. So I'm just gonna have a drink of water. And then we went up, for 154 days until we topped out here, and then we kept dumping. Then we kept dumping. This was the really bad, really bad one. And if we look once again at the fibs here, we reached the top just above 0.5. So you can see that this bounce was pretty violent. If you were living through this at the time, you thought, oh wow, that's it, we're back on track. We got weekly high low, we got uptrend, high low, high, and we are above the 21 EMA. We're gonna keep going up. But nope, we dumped here. So now if we look at this at the SPY right now, we are at the comparison. For example, we bounced to 0382, which is they call it the dead cat bounce. That's the resistance right now, and we got the resistance of the 21 EMA here. So a lot of people here are entering shorts now, and together, if you combine these two signals together, you combine it with the news on CNBC and all other mainstream media, Twitter, everybody's saying this is the death of the market, the bubble has popped, the everything bubble has popped, the coronavirus, everything is stopped, all the businesses have stopped. And we just gonna go down and down and down, right? And they want to enter their shorts here, or they want to sell. So now everybody's trying to time this top. But looking at this very, very ferocious dump, we knew most of this news down the bottom here. We knew this is where we found out that markets, that the governments and the central banks are going to print and print and print and print unlimited money. So and we knew pretty much that most countries are shutting down because of the coronavirus, and they're shutting down for a long time. So once we knew that information, markets priced it in, and they didn't want to go more down because it's priced in now, and we're beginning the bounce. So since the bounce began, we haven't had that much of bad news happening. Most of the bad news might have already been priced in. So now, plus we're at the bottom, plus we're getting the bullish divergence on the daily. So that's why we're having a bounce. And now, because everybody wants to short, market can just as easily keep going up. It can easily go up to 0.5. It can easily go up to 0.6 to bounce before consolidating. So we have to be aware of that, and we have to be prepared that the market doesn't have to go down yet. So it will eventually consolidate. But as we saw before in 2008 picture, and the market just kept going up and didn't consolidate for more than a year, more than 0382, right? When we drew the fibs, it didn't consolidate to 0382 for more than a year back in 2008. So the other thing that we can look at is weekly. So that thing really piqued my interest, and the tweet post from the guy that I really respect, and he said, look, we never had the bullish engulfing candle except for 2008 on the SPX. On SPX, we've never had it except 2009 bottom. So now I went and had a look at it, and let's look at similar cases, right? Even over here when we dumped and then we had the reversal candle, we still had a next week follow through. Next week we had a still massive follow through. So this is on the Monday here, so we are likely to get more follow through here. Now over here we had the dump, we had a massive follow through here as well, many weeks. Even over here we had a follow through for the week, and only the third week we consolidated, and then we attempted it even again. So every time you have the bottom and the candle like that, usually you have at least 1 week of follow through. So over here we didn't. This was the one where we went down again. Yeah, this is the only one that I found after like a somewhat a significant dump that we test the bottom once again, and maybe over here as well. See, but then again, the next week we still had the follow through here before we done it. So, and then I even went to Dow Jones Industrial, and if you look at Dow Jones Industrial and you look at the Great Depression, right? So let's have a quick look at the Great Depression here. In the Great Depression, you can actually find some of these bullish engulfing candles. So, for example, this one here, bullish engulfing candle at the bottom of the trend. But even then, we went up the next week, and then we went up again, right? So we had the follow through here before heading lower. Then we had another one over here. We had another one bullish engulfing candle, and then we had a massive follow through as well, and then we had it lower once again. So, and then we had another one over here, and we had a 1, 2, 3, 4, 5 weeks of follow through before we headed down once again. And then over here we had a bullish engulfing candle. Again, we had a follow through for at least a week. So even here as well, and then we had a massive follow through here. So now if we look at SPX, this is only the Monday of the first week. So the most likely scenario is we are having a follow through. We're having a follow through for at least a week before we start to consolidate. So this week, if anything, if you're a technical analyst, you should be bullish on this week. You know, always be protective, of course, but you know, this is looking like a bull flag right now, right? This is looking like a bull flag, and you know, we are likely to get the follow through. But once again, you know, you always have to be protective, because you know, there are people that are trying to be short here. They're entering their shorts at the 21 EMA and the 0382 resistance here, fibs. So they're entering the shorts, but if we break it, they're gonna cover their short, and we're gonna have some more fuel to go to the upside. So that's the most likely scenario in my head, you know, in my sort of psychologically speaking, right? But let's see what happens, right? So yesterday I had my analysis as well, and I was looking at how am I gonna play. And this was the end of on Friday. We dumped in the end here, and I was looking at it, and I said, hey, you know what? I want to enter bullish. But I want to consolidate some more. And I said to myself, look, I'm gonna enter if we drop down to 0382. And I said, but then that was my first play. I said, yep, I'll enter at the 0382. You got the 0382 plus you got the support over here, and some more action over here around this area. So plus it would be oversold on 15 and 5 minute. And I thought, yep, but then as I did further analysis, I looked, okay, this is the 1 hour 21 EMA here. So what I'll do is I'll put the thing here. So if we do break down from Friday, that means we're breaking down below the 1 hour 21 EMA. Also, I had a look on the 4 hour, and on the 4 hour, which is here, we would have been breaking down from 21 EMA and 8 EMA. So another support, and this is two supports at the same time, right? And then I had a look on the daily as well, and we would have been breaking down below the daily 8 EMA. So I thought, oh, wait, if we break all those supports, actually I'm more bear then bull, and I thought if we break all those supports, I'll be looking at least at the Fibonacci level retracement or the gap close, right? Gap close over here. Otherwise, I'm bullish. Otherwise, my play will be opening when the market opens. I will be looking for bullish entry, and just looking at it on the 5 minutes, what I did yesterday is basically when the market opened, I was looking at it on 2-minute chart. Right, when the market opened here, I was looking at 2-minute and I saw it pump up, and then it started to reverse here. So I actually entered a short on SPXS, and then I covered once I saw the wick here on the 2-minute form, and then I entered a long. I entered a did I? No, I covered my short here, and then I was waiting, right? I was waiting. So I saw that this was the high of the day, this was the bottom of the day, and then I was watching the 2-minute equilibrium form, right? So you can see here, high, low, then we formed a lower high, and then we dropped down here, and then I saw these 2 wicks here on the 2-minute, and I bought a position, SPXL market bought over here somewhere, and then I thought, hey, I'm gonna bottom because I'm bullish biased due to the support from 1 hour 21 EMA, 4 hour 21 and ADMA, and also daily ADMA, and also from analysis of previous bullish engulfing candles. Historically, we're supposed to have follow through for at least a week, so I'm bullish here. So that's why I'm buying the bottom of the 2-minute equilibrium. I bought the 2-minute equilibrium bottom here. It went up here, then it scared me, and it almost broke the support here. It didn't. I would have stopped out. This was my stop here, and then we broke through. As we broke through, I bought some more. I bought another position on the break, and then I held. This gave me a bit of a scare. It went up and down, up and down, up and down here, but it held here, and we had the follow through, and then we went up. And then I said to myself, I will, and I was taking profits here from partial profits, right? It was going up, I was taking profits, everywhere here. And then basically I said to myself, with the rest of it, I'm gonna let it ride on as long as the 2-minute uptrend is holding. And I think I lost the 2-minute uptrend here. It basically faked me out, and then it kept going up. So I had some profits, but I missed out on all this upside here. But you can see how the market would have scared me also over here. It broke this support, and then it kept going up. So, and now what you can see is basically now the market is in in 1 hour. The market is in 1 hour equilibrium now, right? So you can see, I just remove all these. So now we got the bounce high, we got the consolidation low, we got the 1 hour high here, we got the low here, and then we bull flagged over here, and then we broke it at the end of the day. We broke it at the end, so we're basically breaking out of an hourly equilibrium to get some continuation to the upside. And I didn't enter it at the end of the day because I did not trade. I already went to sleep at like 1 a.m. or something. Here, I went to sleep here. And I wasn't going to enter anyway because I wanted to consolidate once more and get a little bit more tighter before breaking through. But instead it broke through. So let's see what's going to happen today, because right now the pre-market is open, and we are going to see if we're going to get follow through here. We are likely to get the follow through because we broke the 1 hour equilibrium bull here, and combining it together with the weekly bullish engulfing candle, we're likely to go up. So I don't know, let's have a quick look at the resistance here. This is a next resistance on the hourly, and the other reason I didn't want to enter on the break of it is because the daily 21 EMA is right here, and also it's 0382 fibs, right? It's the that get bounce territory. So because of there's mixed signals here, you don't want to enter on mixed signals. So yeah, you can see here is the daily lower high is our next resistance, and yeah, that resistance is 3.2% above, so it's a good trade if you get in and you get 3% follow through, or instead of 3% you just get 2. Let's see what's gonna happen. It's gonna be interesting if we do consolidate maybe, and maybe we're gonna retouch the. I think it's unlikely. I think we're just gonna go up, but we can also come back and retouch the 21 EMA. If we do come back to retest 21 EMA, I'm gonna enter a position and then do a just like a small flip. But in the end, because of this, because of the psychology here, and because everybody is trying to enter short and trying to sell, and find that basically everybody is trying to find a top, the most likely scenario that's going to happen here is that we're going to have climax top. And the reason we're having climax top is because while everybody is trying to enter short, they keep getting stopped out. It's like, oh, they stopped out, so the ones they stopped out, they get bought. So because everybody is trying to enter short, and to enter short you have to go on leverage, and that means you can get liquidated, and that could happen. And if those liquidation starts happening as we keep going up, we're likely to get the climax top, and then we're gonna go down. So I'm gonna be the only way I'm entering a short position is when we get a climax top, either on 5-minute, at least on the 5-minute or 15-minute or 1 hour climax top sort of thing, and then I'm gonna enter a short once other people are getting liquidated and we're getting a big run up, very fast run up, very quickly. So yeah, and you can see here that the RSI top, this is an important top here, also lines up with this support here, and we're breaking through it, so it's a key as well, follow through. So I'm bullish, I'm still bullish, I'm definitely bullish for tonight, and we're likely to get more follow through, but you always got to be prepared for the worst case scenario, and what you're going to do if your most likely scenario doesn't play out, then you just stop out. Actually, right now I'm cash, so I need to find a good entry, so I'm not sure how I'm going to enter yet. And what I'm likely to do is I will probably enter if we drop to 21 EMA on the hourly, and also what I might do is I might just do the open play, you know, similar to what I played on Monday, which was yesterday. You know, you just wait to see what's gonna happen after the first 15 minutes or so. Then you form the 2-minute queue, and then if the 2-minute equilibrium breaks bullish, you enter. Maybe you add on the consolidation, and then you just follow the uptrend. See, you broke the uptrend on the 2-minute. Maybe you could have exited over here faster, but I had my stop here, and they got me just by the wick. So you know, it's very tricky. I should have left some to ride. I should have left like a small portion with a break-even stop. But you know, I've been stopped out so many times and I didn't stop out. Anyway, trading is a tricky game, so yes, for the next time I could improve. I need to make sure that I always have a small, at least a small runner to route for the trade to mature more, so I can get more gains in the long run, right? I missed out on most of the gains. Yeah, I missed out on 2.3%, which is going to be more because I'm trading SP500, which is a 3x leveraged ETF. So yeah, I missed out on 6 or 7% there. But nevertheless, it's alright. At least I'm positive. As long as you're positive, at least it's fine. So anyway, that's all I wanted to talk about in this video. It's already been 40 minutes, right? 40 minutes. So yeah. But what I want to enter is I want to enter gold. I want to enter gold for a long-term position. Yeah. See you guys later.